it's hard to remember before COVID, but we were writing mortgages at 4.75.
Good morning, everyone. I am here today with Dylan Langei. He is the branch manager and loan officer at Umpqua Bank right here in Barclay Village in Bellingham. Dylan, thanks so much for hopping in to share some updates on what's going on your side of the real estate world.
Yeah, of course. Thanks for having me, Tiffany. Kind of what we're watching as mortgage professionals right now is it's unfortunately just a super volatile market right now. There's some kind of key technical levels and some key things that we're looking at, and I'll kind of vaguely talk about those, just because once again, super volatile. It's changing every day. Sometimes it's changing multiple times a day. It's right now. It's really difficult to be, a home buyer that's out there looking for homes because you can't lock in a rate until you have an accepted purchase and sale agreement. So you're literally floating your interest rate. You may be pre-approved at one level, but until you get that accepted purchase and sale in hand, me as the mortgage professional can't lock your interest rate. So very difficult times and very hard times out in the market right now. So just some things that we're seeing right now. So today is Thursday, March 10th. So I have to now, when I do videos, give dates. The CPI reports came out this morning. What CPI is the Consumer Price Index. And what that is basically what consumers pay for goods, right? You go to the grocery store and you buy some noodles or whatever that is. It's obviously it's all sorts of consumer goods. And what they do is they look at what consumer goods were, in February of last year, of 2021. And those met expectations, but it's 7.9% year over year. So we're spending 7.9% more for common goods, the same common goods that we were, buying in February of 2021. They're now 8% more, right?
Yeah.
So that filters into inflation and long-term inflation expectations. And if anybody's gone to the gas pump lately, right? I think oil was up to $123 a barrel a few days ago, right? I mean, it's just skyrocketed. And partly because of what's happening in Russia and Ukraine, which is super unfortunate, is just pushing a lot of these prices up and inflation up. And there's a lot of sanctions going on from Russian goods and all of that, which is, basically inflation pushes mortgage-backed securities and the stock market prices down, which drives our interest rates up. So that's just kind of overall, I guess, what's happening. And then something to look forward to, and I don't know if it's, look forward to sounds positive, is the Fed's meeting in a few days, March 15th and March 16th. They've talked a lot about, the Fed chair has talked a lot about hiking the Fed rate multiple times this year. The 15th and 16th, we'll see if that happens. I think what they, Russia and Ukraine, that's a huge story that happened since the last Fed meeting. So there's a lot that's going on here. But really, and then, so I guess there's another thing called consumer sentiment, which is basically like how optimistic consumers are about their personal finances and I guess the stability of the economy. And it's at all-time lows right now for some of the reasons that I gave earlier. And the last time the Fed increased the Fed rate when consumer sentiment was this low was in the 70s and 80s, and it pushed us into a recession. So it will be very interesting to see what the Fed Chair Powell does here on the 15th and 16th. And there's multiple Fed meetings throughout the year. So even if they maybe hike rates 0.25%, here in a few days, before we're talking about hiking it 4 to 6 times. I don't think the economy can stomach that or support that. So very interesting times that we're seeing. Mortgage rates, I mean, since the end of December are probably up, in the wheelhouse of 1% on the interest rate. So, definitely, I would say some advice for any clients out there that maybe were pre-approved a few months ago or shopping around right now is make sure you're getting back in front of your mortgage professional and seeing what rates are doing and looking at your buying power. Because, if rates have shifted up 1%, that could substantially hurt your purchasing power, right? And I'm a glass half full kind of guy. So, with maybe these increasing rates, because we were seeing historic, just crazy low mortgage rates, maybe with these kind of getting a little more normal, maybe there's not 60 offers on every single house, and maybe some of those first-time home buyers stand a little bit more of a chance. So that's what I'm like, fingers crossed for, glass half full. That's what I'm, maybe hoping and praying for. But yeah, definitely interesting times out there.
So follow-up question then, the big R word, recession. Technically, we were in one 2 years ago for a number of months because of the stock market crash of March of 2020. And the rhetoric, at least from like the NAR, economists and all of that, is that the next recession is not a housing bubble. It's not because home prices are overinflated and not worth it. From the mortgage side of things, I think that a lot of times when people hear recession, they still have the scar of 2008 and mortgage-backed securities and crummy loan quality from underqualified buyers is sort of the rhetoric that we have.
That's a great question. And I think it's in the back of everyone's head, constantly with, we've been having 15 to 20% appreciation in home values. Mm-hmm. People's income is not going up 15 to 20% year over year. I mean, it's not sustainable. Housing bubble, right? And housing crash, very, very strong terms and strong words. And really, I started my lending career 7 years ago. So in 2008, I wasn't a part of it, but, I've seen The Big Short, right? And it's very fascinating watching that movie. I know that's a little bit of Hollywood, but I've talked to a lot of my colleagues and coworkers that were like, that's not fluffed up. That was real. It was, people were able to get mortgages, under their dogs' names and multiple more stated income. All these borrowers were not approved. And also the terms of the mortgages were 1 year, ARM loans. So your rate's fixed for 1 year, and then there's a balloon payment, or it adjusts, to 8% or 12% after that. There is no way that these people could pay their mortgages. So, I would say, at least my personal production, 90 to 95% are 30-year fixed mortgages, which if you bought in the last few years, you probably have a 2 in front of your loan, or a low 3, right? And that is fixed for 30 years. So even if home prices go down 5, 10%, you still had that 15 to 20% year over year that, we made it through COVID, and not that COVID has is poof gone, but I think we've made it through the really tough part of COVID and the forbearances, right? Banks came out with awesome programs where people could basically put a standstill on their mortgage payments and tack it to the end of their loan. And we made it through that pretty unscathed, right? And a lot of people still have quite a bit of equity, even with not making 6 months of mortgage payments. They still have quite a bit of equity just from owning those homes for years and years. So I think overall we're in a really good spot. There's so many variables and so many moving pieces that, before COVID, when people were saying, what are rates going to do? It's hard to remember before COVID, but we were writing mortgages at 4.75, right? A 30-year fixed was at 4.75, 2018, right around there. And when people were like, what are rates going to do? And I'm like, well, I don't think they're going to go down, right? I don't. And then COVID, boom, hits, right? And so it totally just flipped the script. My advice always for clients is, do some personal budgeting, right? I can tell you what you're qualified for, what you're pre-approved to. There's some, some analytics, some math that goes on it on my end with debt to income ratios and all that. But you personally need to be okay with the monthly payment. And if you're in a 30-year fixed product, the only thing that's really going to change on your monthly payment is the property taxes and potentially your homeowner's insurance. So what that payment's going to be for the next 360 months or 30 years, right? You need to be okay with that. You and your spouse, one of you, decides to quit their job or stay home with the family or whatever, you need to be okay with that payment, right? And you need to look at what the home values are doing. And what I'm telling people is don't anticipate the 15 to 20% appreciation and think, yeah, this is going to continue, because with the rates going up, right, just even that 1%, affordability is definitely going down. So I think we're going to see less multiple offer situations once some things kind of pan out. Because what you're seeing a lot of is cash offers, because a lot of people are pulling out of the stock market and dumping into real estate because the stock market's tanking. And so a lot of people are still seeing these competitive offers. I don't think it's not as much financed offers. I think you're seeing a lot of cash offers with people pulling out of the stock market. So
You think that
that's
is
my crystal ball. That's my
that's
crystal ball.
Oh yeah, we'll definitely hold you to it.
Yeah. I think keep your head up. You know, it's tough. I feel for a lot of my clients, a lot of my buyers that are in this market right now, and especially we're very fortunate where we live, but with that also comes a lot of competition. We're seeing with COVID as well. I mean, this is a reoccurring theme. A lot of people are able to work remotely or hybrid, and we're seeing these really cool, communities like Bellingham explode because people are like, forget Seattle, forget California, forget some of these other areas. Like, we want to live in this really cute little town that, they sell their house for $1 million in California. It's a 2-bed, 1-bath, and they can buy an incredible house for the same price here with a water view, and right. So I just, keep your head up, get your ducks in a row, right? Get pre-underwritten. If you don't know what that is, contact me or contact anybody on the Cohen Group. You guys know, you guys are awesome, but get your ducks in a row sooner than later. Don't wait for that perfect house to magically pop up and then suddenly we're scrambling at the 11th hour to try to get you pre-approved and all that. So get it in, right? Get your documents in, have me run the numbers, run it through underwriting, get a cool little purchase certificate so that you're completely dialed, and you're as good as cash, I like to say.
Yes.
Yeah.
Awesome. Well, thank you so much, Dylan, for taking the time to join me on this call. And I super appreciate you sharing your wisdom and expertise with all of our friends out there in the social media world.
Of course. Yeah. Thanks for having me.